Welcome partners to the 2025 tax season law changes recap video, highlighting the most important updates from the One Big Beautiful Bill Act, signed into law as Public Law 11921 on July 4, 2025. This law introduces significant tax changes that will affect the 2025 tax season and continue through 2028, including new deductions, credits, and reporting requirements. Understanding these changes is essential for accurately preparing client returns and maximizing eligible benefits. The One Big Beautiful Bill was enacted to provide tax relief for individuals, modernize reporting rules, and address the realities of today's workforce, including gig economy and tipped occupations. Key provisions include the tip deduction, overtime deduction, car loan interest deduction, senior deduction, and updates to 1099 reporting thresholds for independent contractors and gig workers. Additionally, the law adjusts the standard deduction, child tax credit, and earned income credit, EIC, all of which can significantly affect taxpayers' refunds. This recap will summarize each new provision, explain the rules and eligibility, highlight reporting requirements, and provide practical guidance for applying the law in real-world situations. We will also show how multiple deductions and credits may interact for a single taxpayer, helping to clarify how clients can maximize their benefits. By the end of this video, you will have a complete overview of the 2025-2028 tax law changes. This knowledge will allow you to guide clients confidently, ensure compliance, and optimize their deductions and credits. The 2025 tax season is fundamentally different from prior years because the One Big Beautiful Bill introduces structural tax relief changes, not just temporary adjustments. Instead of simply modifying existing thresholds, this law adds entirely new deductions, expands key credits, and reverses several reporting rules that were scheduled to tighten. As a result, tax professionals must approach returns with a new planning mindset rather than relying on prior year assumptions. One of the most important differences this season is that income and deductions are now more closely tied to how people actually work and earn money today. The law acknowledges overtime pay, tips, gig income, and older taxpayers in ways the tax code previously ignored. These changes directly affect refund outcomes, filing strategies, and client expectations, particularly for working-class households, service workers, independent contractors, and seniors. Another major shift is the timing and layering of benefits. Several provisions apply immediately for the 2025 tax year, while others phase in or change again between 2026 and 2028. This means preparers must not only know what applies this year, but also how current choices may impact future returns. Clients may need guidance on income timing, filing status decisions, and whether certain deductions are worth claiming now versus later. The 2025 tax season is also different because reporting thresholds did not tighten as expected. The One Big Beautiful Bill stopped previously planned changes that would have dramatically increased IRS reporting on small earners and digital payments. This preserves higher thresholds for certain forms, reducing unexpected tax notices and underreported income issues that many taxpayers feared. Finally, client education plays a much larger role this year. Many taxpayers will hear about new deductions through social media or word of mouth without understanding the rules. Tax professionals must clearly explain eligibility, documentation, and limitations to avoid misinterpretation and compliance problems. Key takeaways for the 2025 tax season. The law introduces new deductions, not just threshold changes. Credits and deductions interact more than in prior years. Some benefits change again between 2026 and 2028. Reporting rules are more stable than previously planned. Client education and planning are more important than ever. One of the most important and immediately impactful changes under the One Big Beautiful Bill is the update to the standard deduction. The standard deduction affects nearly every taxpayer, especially working class, households who do not itemize. By increasing the standard deduction, the law reduces taxable income upfront, which often results in lower tax liability and, in many cases, higher refunds. For the 2025 tax season, the standard deduction has been increased and locked in at higher levels than prior law projections. This change is significant because without this bill, the standard deduction was expected to adjust more slowly and potentially decrease in real value due to inflation. The One Big Beautiful Bill ensures that taxpayers keep more of their income shielded from federal taxation. This change benefits W-2 employees, retirees, and self-employed individuals alike. It also simplifies return preparation for many clients, as fewer taxpayers will benefit from itemizing deductions. For tax professionals, this means greater emphasis on evaluating whether itemizing still makes sense, especially when combined with new deductions introduced by the law. Another key point is stability. The One Big Beautiful Bill provides consistency by preventing sudden reductions in the standard deduction through at least 2028. This allows tax professionals to better plan with clients over multiple years rather than reacting to annual legislative uncertainty. These higher standard deduction amounts mean that many taxpayers will owe less tax before credits are even applied. Key takeaways. The standard deduction is increased and protected through 2028. Most taxpayers will benefit without itemizing. Lower taxable income often results in higher refunds. Provides multi-year planning stability. Another change is tax brackets are now permanent and inflation adjusted, providing predictability. Only the portion of income within each bracket is taxed at that rate, which is important for withholding and refund planning. Example, a single client earning $95,000 pays 10% on the first $11,000, 12% on the next $33,725, and 22% on the remaining $50,650, showing how progressive taxation reduces overall liability. Key takeaways. Brackets are permanent and predictable. Only income in each bracket is taxed at that rate. Helps clients plan withholding and estimate refunds. The Earned Income Credit, often called the EIC or EITC, is a refundable tax credit that is updated every year to account for inflation and economic changes. Unlike some of the new deductions created under the One Big Beautiful Bill, the Earned Income Credit is not a new law, but rather an annual adjustment that impacts eligibility, income limits, and maximum credit amounts for the 2025 tax season. For 2025, the IRS increased the income thresholds that determine who qualifies for the credit. This allows taxpayers to earn more income while still remaining eligible, which is especially important as wages continue to rise due to inflation. These adjustments prevent working families from losing the credit simply because their income increased slightly year over year. The maximum credit amounts have also been adjusted for 2025 based on the number of qualifying children claimed on the return. Households with more qualifying children continue to receive higher credits, while workers without qualifying children still have access to a smaller but meaningful refundable credit. The Earned Income Credit remains fully refundable, meaning eligible taxpayers can receive the credit even if they owe no federal income tax. For many low and moderate income households, the EIC is one of the largest contributors to their annual refund, making it a key focus during tax preparation. It is also important to note that strict eligibility rules continue to apply. Taxpayers must meet earned income requirements, investment income limits, filing status rules, and qualifying child tests where applicable. Due diligence requirements for tax preparers remain in effect, and accurate documentation is critical when claiming this credit. When applying the Earned Income Credit in real tax situations, most taxpayers do not receive the maximum credit shown on charts. Instead, the actual credit amount depends on how earned income, filing status, and number of qualifying children work together as income increases. For the 2025 tax season, the EIC still follows a phase-in and phase-out structure, but the higher income limits mean taxpayers can earn more before the credit is reduced. The Earned Income Credit increases as earned income rises until it reaches a maximum level. After that point, the credit stays flat for a short range of income. Once income exceeds the phase-out threshold, the credit begins to decrease gradually until it is fully eliminated. This reduction happens slowly, which means taxpayers may still qualify for a partial credit even when their income is well above the amount needed to receive the maximum benefit. For married taxpayers filing jointly, both spouses' income is combined when determining eligibility. Even if one spouse earns significantly less, the total household income controls how far into the phase-out range the return falls. This can be especially important for dual-income households where one spouse takes on additional hours or a second job during the year. Example, a married couple filing jointly has 2 qualifying children. One spouse earns $42,000 and the other earns $18,000 for a combined income of $60,000. Under the 2025 limits, the couple still qualifies for the Earned Income Credit, but they are in the phase-out range. Instead of receiving the full $7,150 maximum credit, their EIC is partially reduced based on how far their income exceeds the phase-out starting point. Even with the reduction, the couple still receives a meaningful refundable credit that increases their refund. Investment income can completely change the outcome. If that same household also received $13,000 in investment income, such as dividends or capital gains, they would be disqualified from the EIC entirely for 2025, regardless of wages or number of children. Example, a single taxpayer with one qualifying child earns $35,000 in wages and receives $2,000 in interest income. Because the investment income is under the $11,950 limit, the taxpayer remains eligible for the EIC and receives a reduced but still refundable credit. If their investment income had exceeded the limit, the credit would be lost completely. It is also important to understand that deductions do not directly control the EIC. The credit is based on earned income and adjusted gross income, not taxable income after deductions. This means that even if deductions lower the tax owed, they may not restore an earned income credit that has already phased out. Key takeaways. Most taxpayers receive partial, not maximum, EIC. Combined income controls phase-out placement. MFJ status allows higher income before full phase-out investment income over the limit eliminates the credit. EIC is refundable but tightly regulated. The child tax credit continues to be one of the most important credits for families with dependent children. And while it is not part of the One Big Beautiful Bill, it is adjusted and applied annually under existing tax law. For the 2025 tax season, the structure of the child tax credit remains largely the same, but understanding how much is refundable, how income impacts eligibility, and how the credit applies per child is critical for accurate tax planning and preparation. For 2025, the child tax credit allows eligible taxpayers to claim up to $2,000 per qualifying child who is under age 17 at the end of the tax year and has a valid Social Security number. Of that amount, up to $1,700 per child is refundable as the additional child tax credit. This means families may receive part of the credit as a refund, even if they do not owe federal income tax. The refundable portion is especially important for low and moderate income families. While the full $2,000 credit is first used to reduce tax liability, the refundable portion can generate a refund once the tax owed is reduced to zero. This structure makes the child tax credit both a tax reduction tool and a refund generating credit depending on the household's income level. Income limits still play a role. The credit begins to phase out when modified adjusted gross income exceeds $200,000 for single filers and $400,000 for married filing jointly. Families above these thresholds may still qualify for part of the credit, but the amount is reduced as income increases. The real-world impact of the child tax credit becomes clearer when looking at how it interacts with adjusted gross income, AGI, filing status, and other credits and deductions on the return. While the headline number is $2,000 per child, not every family receives the full amount, especially as income rises. The child tax credit begins to phase out once income exceeds the applicable threshold. For married couples filing jointly, that threshold is significantly higher than for single filers, which allows many middle and upper middle income families to continue receiving at least a portion of the credit. The phase-out occurs gradually, reducing the credit by $50 for every $1,000 of income above the threshold. Unlike refundable credits, such as the earned income credit, the child tax credit is closely tied to tax liability. This means families with higher incomes may still qualify for the credit, but it will only reduce their tax owed rather than generate a refund if their income is too high to qualify for the refundable portion. It is also important to understand how the child tax credit interacts with other deductions. While deductions can lower taxable income, the child tax credit phase-out is based on AGI, not taxable income. As a result, certain deductions may not reduce income enough to preserve the full credit once a taxpayer enters the phase-out range. Example, a married couple filing jointly has 2 qualifying children and an AGI of $180,000. Because their income is below the $400,000 phase-out threshold, they are eligible for the full $4,000 child tax credit. If their AGI increased to $420,000, part of the credit would be phased out, reducing the total amount they could claim, even though the children still qualify. One of the most talked about provisions in the One Big Beautiful Bill is the new No Tax on Tips deduction, which applies beginning in the 2025 tax year and runs through 2028. This is a new above-the-line deduction, meaning taxpayers can claim it whether they itemize or take the standard deduction. The purpose of this change is to reduce the tax burden on workers in traditionally tipped occupations. Under this law, both employees and self-employed individuals may deduct qualified tips that are properly reported. Qualified tips include voluntary cash or charge tips received directly from customers or through tip pooling arrangements. These tips must be reported on a Form W-2, Form 1099, or other IRS-approved statement, or reported directly by the taxpayer using Form 4137. the maximum deduction allowed is $25,000 per year. For self-employed individuals, the deduction cannot exceed their net income from the trade or business where the tips were earned. This ensures the deduction offsets actual earned income rather than creating a loss. The deduction is subject to an AGI phase-out. Taxpayers with modified adjusted gross income over $150,000 or $300,000 for married filing jointly will see the deduction gradually reduced and eventually eliminated. Additionally, individuals working in a specified service, trade, or business, SSTB, under Section 199 are not eligible, and employees of SSTBs are also excluded. Example: a restaurant server earns $40,000 in wages and $10,000 in qualified reported tips during 2025. Because the tips are reported and the taxpayer's income is below the phase-out threshold, the full $10,000 may be deducted, reducing taxable income even though the standard deduction is still claimed. While the no tax on tips deduction provides meaningful relief, it also introduces new reporting and documentation requirements. Employers and other payers must now file information returns with the IRS and furnish statements to employees showing the total amount of cash tips received and the occupation of the tip recipient. This ensures the IRS can verify that tips qualify for the deduction. Taxpayers must still properly report tips as income. The deduction does not eliminate reporting requirements. It only allows a deduction after income is reported. Employees who receive tips not included on their W-2 must continue to report them using Form 4137. Failure to report tips correctly may disqualify the deduction and expose the taxpayer to penalties. The IRS is required to publish by October 2, 2025, a list of occupations that customarily and regularly receive tips before December 31, 2024. Only taxpayers working in those occupations are eligible. For 2025, the IRS will provide transition relief while employers and payers adjust to the new reporting rules. High-income taxpayers must also be mindful of the phase-out. As AGI exceeds $150,000, $300,000 MFJ, the deduction is reduced. This means accurate income calculation is critical when determining how much of the deduction can be claimed. Example: an employee receives a W-2 showing $8,000 in reported tips. The employee's AGI is below the phase-out limit, so the $8,000 is deducted on the return, lowering taxable income while remaining fully compliant with IRS reporting rules. Another major change under the One Big Beautiful Bill is the no tax on overtime deduction, effective for tax years 2025 through 2028. This provision allows workers to deduct qualified overtime compensation, specifically the portion of overtime pay that exceeds the employee's regular hourly rate. Under the Fair Labor Standards Act, FLSA, overtime is typically paid at time and a half. Only the half portion above the regular rate qualifies for the deduction. The regular base pay remains taxable and is not deductible. The maximum annual deduction is $12,500 for single filers and $25,000 for married filing jointly. Like the tips deduction, this is an above-the-line deduction available to both itemizing and non-itemizing taxpayers. The deduction applies only to overtime that is required by law and properly reported on a Form W-2, Form 1099, or similar statement. Voluntary bonuses, shift differentials, or premium pay not classified as overtime under FLSA rules do not qualify. Example: an employee earns $6,000 in overtime pay during 2025. Of that amount, $2,000 represents the half-time premium required by law. The employee may deduct the $2,000, reducing taxable income while still reporting the full overtime wages. The overtime deduction also comes with new employer reporting responsibilities. Employers and other payers must furnish statements showing the total amount of qualified overtime compensation paid during the year. This allows taxpayers to substantiate the deductible portion of their overtime pay. As with tips, the deduction phases out for higher income taxpayers. The phase-out begins at $150,000 of modified AGI, $300,000 for joint filers. Once income exceeds these limits, the deductible amount is reduced and eventually eliminated. The IRS has announced transition relief for the 2025 tax year, recognizing that employers may need time to adjust payroll systems to track and report qualified overtime separately. However, taxpayers must still maintain accurate records and rely on employer statements when claiming the deduction. It is important to note that the overtime deduction reduces adjusted gross income, which can positively affect eligibility for other credits and deductions. However, incorrect reporting or overstating qualified overtime can result in disallowed deductions and potential penalties. Example, an employee receives an employer statement showing $3,500 of qualified overtime premium pay. The employee's AGI is $95,000, well below the phase-out threshold, so the full $3,500 is deducted, lowering AGI and overall tax liability. While the One Big Beautiful Bill Act provides meaningful deductions for tips and overtime, not all workers qualify, and understanding exclusions is just as important as understanding benefits. One of the most critical exclusions applies to specified service trades or businesses, SSTBs, and certain self-employed individuals. An SSTB includes professions such as law, accounting, consulting, financial services, health services, and similar fields where income is primarily based on reputation or specialized skill. Under the law, self-employed individuals operating an SSTB are not eligible for the tip deduction, even if they receive payments that resemble tips. Likewise, employees whose employer operates as an SSTB are also excluded from the tip deduction. This rule prevents high-income professional service providers from claiming deductions intended for traditionally tipped occupations. The IRS will publish an official list of qualifying tip-based occupations, and eligibility is tied directly to that list. Overtime deductions follow different rules. While self-employed individuals can receive 1099 income, overtime deductions only apply when the overtime is required under the Fair Labor Standards Act, FLSA. Most self-employed individuals do not qualify for overtime under FLSA, making the deduction unavailable in many independent contractor situations. Example, a self-employed consultant receives tips from satisfied clients through invoices. Because consulting is an SSTB, those amounts do not qualify as deductible tips, even though they are voluntary payments. Important exclusion reminders. SSTB self-employed individuals cannot deduct tips. Employees of SSTBs cannot deduct tips. Overtime must be FLSA required. To qualify, misclassifying income can lead to denied deductions. IRS occupation list controls. Eligibility understanding exclusions protects taxpayers from claiming deductions they are not entitled to and facing penalties later. Information return reporting continues to be a major focus for the IRS, and the 2025 tax season brings important clarification around 1099 income. While much of the public conversation has focused on new thresholds, it is critical to separate reporting thresholds from taxability rules. The One Big Beautiful Bill and related IRS guidance adjust how and when income is reported, but they do not change the requirement to report taxable income, regardless of whether a form is received. For tax professionals and taxpayers alike, this distinction is essential. A reporting threshold determines when a payer must issue a form to the IRS and the taxpayer. It does not determine whether the income is taxable. All self-employment or business activity and gig income remains taxable when earned, even if no 1099 is issued. This section sets the foundation for understanding how the 1099 NEC and 1099K rules differ, why thresholds matter for compliance, and how these changes affect documentation, planning, and audit risk going forward. Example, a taxpayer performs freelance work and earns $1,200 from a single client in 2025. Even if the client does not issue a 1099 NEC due to reporting thresholds, the taxpayer is still required to report the $1,200 as income on their tax return. One of the most significant future-facing changes involves Form 1099 NEC, which is used to report non-employee compensation. Under the updated rules, the reporting threshold will increase from $600 to $2,000, effective for payments made in 2026, which will be reported on 2027 tax returns. This change reduces the reporting burden on businesses that make smaller payments to contractors, but it does not eliminate tax responsibility for the recipient. Non-employee compensation remains fully taxable and subject to self-employment or business activity tax, regardless of whether a 1099 NEC is issued. Tax professionals should begin advising clients now so there is no confusion when fewer 1099 NECs are received in future years. Contractors must maintain their own income records and cannot rely solely on forms received to determine what is taxable. Example, a freelancer earns $1,300 from a client in 2026. Because the total is below the new $2,000 threshold, the client does not issue a 1099 NEC. However, the freelancer must still report the full $1,800 as income on their 2026 return filed in 2027. 1099 NEC income does not exist in isolation. In real tax situations, it interacts with the standard deduction, self-employment or business activity tax, and refundable credits such as the earned income credit and child tax credit. While the reporting threshold may change, the way income flows through the return remains the same. Non-employee compensation is included in gross income and increases adjusted gross income. From there, deductions such as the standard deduction reduce taxable income, but they do not eliminate self-employment or business activity tax. Credits like the EIC are based on earned income and AGI, meaning 1099 income can both increase eligibility and push taxpayers into phase-out ranges depending on the total amount earned. Example, a single freelancer earns $22,000 on a 1099 NEC and has no other income. After claiming the standard deduction, their taxable income is reduced significantly, but they still owe self-employment or business activity tax. Because the income is earned income and within the EIC limits, the taxpayer may qualify for the earned income credit, partially offsetting the overall tax owed. One of the most important clarifications under the One Big Beautiful Bill is what it did not allow to happen. Prior IRS guidance planned to lower the Form 1099-K reporting threshold to $600, which would have required payment platforms to issue 1099-Ks for even small amounts of activity. The One Big Beautiful Bill stopped that change, keeping the reporting threshold at $20,000 and 200 transactions. This repeal is significant for gig workers, casual sellers, and taxpayers using payment platforms for side income. Under the Stop $600 rule, millions of taxpayers would have received 10 to 99Ks for minimal or occasional activity, increasing confusion and audit risk. By keeping the higher threshold, the law limits reporting to higher volume activity, while still requiring taxpayers to accurately report income earned. However, this change does not reduce tax responsibility. Even without a 1099-K, income earned through payment platforms is still taxable. The key update is about reporting, not taxability. Taxpayers must continue to track income independently using platform summaries, bank deposits, and personal records. When 1099-K income is combined with other income, it affects adjusted gross income, AGI. AGI is the measurement used to determine eligibility for many credits and deductions, including the Earned Income Credit, Child Tax Credit, and several new deductions created by the One Big Beautiful Bill. While deductions may reduce taxable income, AGI-based phase-outs still apply. Example, a taxpayer earns $1,800 through a payment platform in 2025 and does not receive a 1099-K because the 20,200 transaction threshold is not met. The taxpayer also claims a deduction for car loan interest under the One Big Beautiful Bill. While the deduction lowers taxable income, the full $18,500 still counts toward AGI when determining eligibility for refundable credits, which may reduce or phase out those benefits. The car loan interest deduction is a brand new provision created under the One Big Beautiful Bill and applies for tax years 2025 through 2028. This deduction allows individuals to deduct interest paid on a loan used to purchase a qualified personal use vehicle, regardless of whether they itemize or take the standard deduction. The intent of this provision is to reduce the cost of vehicle ownership for everyday taxpayers, not businesses. For eligible taxpayers, the maximum deduction is $10,000 per year. The deduction applies only to interest, not principal payments, and only to loans originated after December 31st, 2024. Used vehicles do not qualify. The original use of the vehicle must begin with the taxpayer, meaning the car must be purchased new. The vehicle must be for personal use only. Vehicles used for business, rideshare, delivery, or commercial purposes do not qualify under this deduction. In addition, the loan must be secured by the vehicle, meaning the lender has a lien on the car. There are also income-based phase-outs. The deduction begins to phase out when modified adjusted gross income exceeds $100,000 for single filers and $200,000 for married filing jointly. As income increases beyond these thresholds, the deductible amount is gradually reduced until it is fully eliminated. Another important eligibility rule is that the vehicle must meet the definition of a qualified vehicle. This includes cars, SUVs, vans, pickup trucks, motorcycles, and similar vehicles with a gross vehicle weight rating under 14,000 pounds. Additionally, the vehicle must have undergone final assembly in the United States, which can be verified through the Vehicle Information Label, or VIN. While the car loan interest deduction provides meaningful tax relief, it also comes with specific reporting and documentation requirements. Taxpayers must be able to substantiate that the vehicle and loan meet all eligibility criteria. Unlike general interest deductions of the past, this deduction requires vehicle-level verification. One of the most important requirements is including the Vehicle Identification Number, VIN, on the tax return for any year in which the deduction is claimed. This allows the IRS to confirm that the vehicle qualifies, including verifying final assembly in the United States. Without a valid VIN, the deduction may be disallowed. Taxpayers must also rely on lender-provided statements showing the total amount of interest paid during the year. These statements must clearly separate interest from principal. Lenders and other recipients of qualified interest are required to file information returns with the IRS and furnish statements to taxpayers showing the total interest received. The IRS has announced transition relief for the 2025 tax year, recognizing that lenders and taxpayers may need time to adjust to the new reporting requirements. However, this relief does not eliminate the need for accurate records. Taxpayers should retain loan documents, interest statements, and proof of vehicle eligibility in case of IRS inquiry. It is also important to note that refinancing a qualifying vehicle loan does not automatically disqualify the interest. In most cases, interest paid on a refinanced loan remains eligible, provided the original loan met all requirements and the refinanced amount does not exceed the original loan balance. Example: a taxpayer files their 2025 return and claims the car loan interest deduction. They include the VIN on the return and attach the lender's annual statement showing $6,500 of interest paid. Because the documentation is complete, the deduction is allowed without issue. The car loan interest deduction does not exist in isolation. In real-world tax preparation, it interacts with the standard deduction, child tax credit, earned income credit, and the new deductions for tips and overtime under the One Big Beautiful Bill. Understanding how these pieces work together is critical for accurate planning. This deduction is an above-the-line deduction, meaning it reduces adjusted gross income, AGI. Lowering AGI can help taxpayers qualify for or preserve other credits that are subject to income limits. However, it does not replace or reduce the standard deduction. Taxpayers still claim the full standard deduction in addition to this benefit. As income increases, the phase-out rules become especially important. Even if a taxpayer qualifies for the deduction based on vehicle eligibility, higher AGI may reduce or eliminate the benefit. This is particularly relevant for households claiming multiple new deductions, as combined income can quickly approach phase-out thresholds. When combined with a child tax credit or earned income credit, the reduction in AGI may help offset phase-outs or improve refund outcomes. However, taxpayers should not assume that deductions automatically restore credits, as many credits are calculated using AGI before certain adjustments. Example: a taxpayer purchases a new personal use vehicle in 2025 that was assembled in the United States. During the year, they pay $8,000 in interest on the auto loan. Because the loan qualifies and their income is below the phase-out threshold, the full $8,000 is deductible, reducing their adjusted gross income. Another example is a married couple claims the standard deduction, deducts qualified car loan interest, and also claims deductions for overtime and tips. While the combined deductions significantly reduce taxable income, their AGI remains high enough that part of the child tax credit is phased out. This illustrates why understanding AGI, not just taxable income, is essential when applying multiple deductions and credits together. The senior deduction is a new provision introduced under the One Big Beautiful Bill and applies to tax years 2025 through 2028. This deduction is designed to provide targeted relief to older taxpayers by reducing taxable income beyond what is already allowed through the standard deduction. The senior deduction is $6,000 per qualifying individual, meaning married couples where both spouses qualify may deduct up to $12,000. To qualify, the taxpayer must be age 65 or older by the end of the tax year. The deduction is available to both single and married filers and is claimed in addition to the standard deduction, not instead of it. This distinction is critical, as many taxpayers mistakenly assume it replaces existing age-based increases. It does not, it stacks on top. The deduction is subject to income-based phase-outs. For single filers, the phase-out begins when modified adjusted gross income exceeds $75,000. For married filing jointly, the phase-out begins at $150,000. As income rises above these thresholds, the deductible amount is gradually reduced until it is fully eliminated at higher income levels. Only individuals with valid Social Security numbers may claim the deduction. Married couples filing jointly must meet the age requirement separately to claim each individual deduction. If only one spouse is age 65 or older, only one $6,000 deduction is allowed. The senior deduction applies regardless of income source. wage income, retirement income, Social Security, tip income, and investment income all count toward AGI when determining eligibility. The deduction is intended to offset rising living costs for seniors rather than target a specific income type. Example, a married couple, both age 66, files jointly with household income of $120,000. Because their income is below the $150,000 phase-out threshold, they qualify for the full senior deduction of $12,000 in addition to their standard deduction, significantly reducing taxable income. Claiming the senior deduction requires careful attention to filing status, age verification, and income thresholds. While the deduction itself does not require additional forms, eligibility is validated through taxpayer information already included on the return, including dates of birth and Social Security numbers. The deduction is claimed directly on the individual income tax return and calculated automatically when age requirements and filing status are properly indicated. Tax software will apply the deduction if eligibility criteria are met, but incorrect data entry can prevent it from being allowed. Joint filers should understand that the deduction is individual-based, not household-based. Each spouse must meet the age requirement separately. If one spouse is under 65, only one $6,000 deduction is permitted, even though the return is filed jointly. Phase-outs operate based on modified adjusted gross income, not taxable income. This distinction matters because taxpayers often assume that taking deductions such as car loan interest, tips, or overtime will restore the full senior deduction. While those deductions may reduce taxable income, they do not always reduce AGI enough to reverse a phase-out. Strategic filing can impact eligibility. In some cases, married couples may consider whether filing jointly or separately produces a better outcome. However, filing separately often limits access to other credits and deductions, so this decision should be evaluated carefully. Example, a single filer age 66 earns $92,000 and claims the senior deduction, but receives only a partial deduction due to the phase-out. A married couple with the same combined income files jointly and qualifies for a higher total deduction because the joint phase-out threshold is higher. When combined with other provisions under the One Big Beautiful Bill, the senior deduction plays a powerful role in reducing overall tax liability. Because it stacks with the standard deduction and other above-the-line deductions, it can significantly lower taxable income for older households. Seniors who earn tip income, overtime, or pay qualifying car loan interest may claim those deductions, in addition to the senior deduction, provided all eligibility requirements are met. However, these deductions interact primarily through AGI, which remains the controlling factor for phase-outs. This makes planning especially important. While deductions may reduce taxable income, AGI may still exceed thresholds for credits such as the child tax credit or earned income credit, even after applying the senior deduction. Example, a married couple, both over 65, earns tip income from part-time work and pays interest on a qualifying car loan. They claim the standard deduction, senior deduction, tip deduction, and car loan interest deduction. While taxable income drops significantly, their AGI remains high enough that certain credits are partially phased out. As tax law becomes more deduction-focused, documentation becomes the backbone of a defensible tax return. For the 2025 tax season, this is especially true with the introduction of new deductions for tips, overtime, and car loan interest. While the deductions themselves can significantly reduce taxable income, they are only allowed if the taxpayer can substantiate them with proper records. The IRS does not accept estimates, memory, or verbal explanations as documentation. For tip income, taxpayers must retain employer-issued statements, point-of-sale summaries, pay stubs, or Forms W-2 or 1099 that reflect tips received. If tips are not fully captured on a W-2, Form 41 to 37 and supporting records may be required. Overtime deductions rely on payroll records clearly showing regular pay versus the overtime premium portion. Without this distinction, the deduction may be disallowed. Vehicle-related deductions, such as the car loan interest deduction, require even more specific documentation. Taxpayers must keep lender statements showing interest paid, loan origination documents proving the loan qualifies, and the vehicle identification number, VIN, to confirm eligibility. For any work-related deductions, contemporaneous records are key, meaning logs and receipts created at the time of the expense, not recreated later. Example, a taxpayer working in hospitality keeps monthly payroll summaries showing tips and overtime pay, saves lender statements for their vehicle loan, and maintains a digital folder with all documents. When filing, every deduction claimed is supported by third-party records, reducing audit risk and ensuring the deductions are allowed. Best practices for documentation. Save all W-2s, 1099s, and employer statements. Keep lender interest statements and VIN records. Maintain logs for tips and overtime if forms are incomplete. Store records digitally for easy retrieval. Retain documentation for at least 3 years. Strong documentation turns deductions into protection, not liability. With multiple deductions and credits now interacting on the same return, calculating taxable income in 2025 requires a more structured step-by-step approach. Taxpayers and preparers must understand the order of operations. Income first, then adjustments, then deductions, followed by credits. Skipping steps or misunderstanding sequencing can lead to incorrect results. The process begins with total income, including wages, tips, overtime, self-employment, or business activity income, and any 1099 income. From there, applicable above-the-line deductions, such as tip and overtime deductions, are applied, reducing adjusted gross income, AGI. AGI is a critical number because many credits and deductions phase out based on it. Next, the taxpayer applies either the standard deduction or itemized deductions. Credits such as the child tax credit and earned income credit are calculated after tax liability is determined, directly reducing the tax owed or increasing the refund. Example: a taxpayer earns $45,000 in W-2 wages, $8,000 in tips, and $4,000 in qualified overtime. They deduct the eligible portion of tips and overtime, reducing AGI. After claiming the standard deduction, they calculate tax owed and then apply the child tax credit and earned income credit. The final result is a significantly lower tax liability and a larger refund than prior years. Key calculation reminders: income includes all sources, even if deductible later. Tip and overtime deductions reduce AGI. Credits apply after tax is calculated. Phase-outs depend on AGI, not gross income. Order matters. Missteps change outcomes. Understanding how these pieces fit together is essential to accurate tax preparation. With new deductions and updated thresholds, the 2025 tax season presents more opportunities for mistakes. Many of the most common errors are not intentional, but stem from misunderstanding how income, deductions, and reporting interact. Unfortunately, even small errors can trigger IRS notices, refund delays, or penalties. One frequent mistake is failing to report all income, especially 1099 NEC income, under the assumption that amounts below certain thresholds are not taxable. While reporting thresholds affect whether a form is issued, all income is still taxable. Another common error is claiming deductions without proper documentation or claiming deductions for which the taxpayer is not eligible, such as tip deductions for SSTB workers. Phase-out errors are also widespread. Taxpayers often overlook how additional income, bonuses, side work, or investment income can reduce or eliminate credits like the EIC or child tax credit. Example: a freelancer earns $1,800 from a client and does not receive a 1099 NEC. Believing the income is under the limit, they fail to report it. The IRS later matches bank deposits to reported income and issues a notice, increasing tax owed and penalties. How to avoid common errors: report all income regardless of forms received. Verify eligibility before claiming deductions. Track AGI carefully to anticipate phase-outs. Review all IRS forms for accuracy. Avoid assumptions based on prior year rules. Prevention is always easier than correction. It's important to step back and review how all the 2025 updates work together. This tax season is not about one change. It's about the interaction of deductions, credits, reporting requirements, and income thresholds. Taxpayers may now deduct qualified tips, overtime, car loan interest, and senior deductions while also navigating updated EIC and child tax credit rules. Employers and payers play a larger role in reporting, and documentation is more critical than ever. Phase-outs apply across multiple areas, making AGI management a central theme of 2025 tax planning. Key takeaways: more deductions but stricter documentation. Reporting accuracy drives deduction eligibility. AGI controls credits and phase-outs. Planning matters beyond a single year. Education is the strongest compliance tool. This concludes the core instructional portion and sets the foundation for confident, compliant tax preparation in 2025 and beyond. It's important to step back and review how all the 2025 updates work together. This tax season is not about one change. It's about the interaction of deductions, credits, reporting requirements, and income thresholds. Taxpayers may now deduct qualified tips, overtime, car loan interest, and senior deductions while also navigating updated EIC and child tax credit rules. Employers and payers play a larger role in reporting, and documentation is more critical than ever. Phase-outs apply across multiple areas, making AGI management a central theme of 2025 tax planning. Key takeaways: more deductions but stricter documentation. Reporting accuracy drives deduction eligibility. AGI controls credits and phase-outs. Planning matters beyond a single year. Education is the strongest compliance tool. This concludes the core instructional portion and sets the foundation for confident, compliant tax preparation in 2025 and beyond.